So, we are on question number 2 now. Here we are calculating again a make and buy scenario. So, this is the question which is on bicycles. So, Bluebird Limited makes and sells bicycles. It manufactures bicycle. It is considering an offer from outside vendor to supply any number of chains at rupees 12 per unit. So, it is considering a vendor's order at rupees 12 per unit for supplying the chains. The direct material, direct labor, variable manufacturing overhead is provided in the question. Also, you are provided inspection setup cost, machine rent, allocated fixed overhead. The following additional information is available. Inspection setup cost vary with number of batches in which chains are produced. Currently, chains are being produced in the batch size of 2000 units. Direct labor cost represent wages for 4 workers who are totally engaged for making manufacturing of chains. They are permanent worker and can't be removed. So, the second point is not relevant for decision making. Why? A permanent worker who cannot be removed from the work is not a relevant cost. Friends, we will go to relevant cost separately. I am just referring this in context to the point given in the question. If Bluebird procures all its chains from outside vendor, it will not require machine which it has hired for manufacturing chain. So, what does this point suggest? This point suggests that if the company takes all chains from outsider, it is not going to use its internal manufacturing chain facility. So, there will be a saving, right? Now, what are the requirement of the question? You have 3 parts of the question. The first part being, assume if Bluebird Limited purchase chains from outside vendor, the facility where the chains are currently manufactured will remain idle. So, should Bluebird Limited accept the offer from outside vendor at the anticipated production and sales volume of 24,000 units? So, what is the question? Should it produce it internally or should it agree to the outside vendor? So, this decision can be taken. So, let us solve this thing with me. So, this is statement of decision on offer from outside vendor. So, what you are doing? You are evaluating the offer from outside vendor with respect to your internal manufacturing. So, versus internal manufacture, right? So, what is the offered price? This is at the rate of rupees 12 less variable cost per unit. This is buying from outside. This is internal manufacture. So what you find? Internal price is less. So excess of offered price over manufacture is 5. So for 24,000 units, this is the decision point. This is per unit. So decision for 24,000 units will give you 1,20,000. Now there are few more points. If you go through the additional information, it says inspection setup cost vary with number of batches. Currently chains are produced in batch size of 2,000 units. So you have to see how to deal with this inspection setup cost. How many batches you will be having? One batch size is for 2,000. So you are manufacturing 24,000. So you have 12 batches. If you have 12 batches at the rate of rupees 2,000 per inspection cost, you will be incurring 24,000 rupees. So please mention it. Less avoidable cost. So what you will avoid? You will avoid inspection cost. How much? It is 12 batches at the rate of 2,000 per batch. Also, the point says if Bluebird procures everything from outside, it will not require machine which it has hired to manufacturing chain. So what is the machine rent? Machine rent is rupees 1 per unit. So there will be a saving of machine rent. How much? For 24,000 units at the rate of rupees 1. So 24,000 here also. Right? So what is the final answer? If you subtract 48,000 from 1,20,000, what you get? Excess of offered price from vendor over internal cost. So it works out 72,000 rupees. So outside vendor's proposal should not be accepted because your own profit will be reduced by rupees 72,000. So it is not advisable to accept the offer. So the decision is, it is advised to manufacture internally. Right? So this is the first part. The second part of the question says whether your decision in point number 1 will change if facilities can be used to upgrade the bicycle, which will result in an incremental revenue of rupees 22 per cycle. The variable cost of upgrading the bicycle is rupees 18 and tooling cost will be rupees 16,000. So friend, in the second case you may notice you have to compare incremental revenue with incremental cost. So what does the term incremental revenue means? It means extra revenue what you get. And what is the differential cost? This means extra cost which you will be incurring. So incremental revenue per bicycle is rupees 22 less differential cost. This is 18. So contribution per bicycle is rupees 4. So total contribution, because you are deciding for how many units? 24,000 units. This becomes 96,000 rupees less tooling cost 16,000. So net contribution will be 80,000 rupees. So what is the decision? Accept the offer. So this offer is correct for the business. So you may be noticing there are many types of businesses decisions which are likely to be taken. Short term business decisions. So these decisions are going to help the business to run smoothly. So friend, now let us work on the third part of the question, the last part. The question says the batch size could be improved to 4,000 rupees. So the number of batches which was 2,000 will be 4,000. So instead of having 12 batches, now we are going to have 6 batches. So friend, in this scenario, when batch size changes, there is saving of amount on batch size. How much is the saving? Saving is rupees 2,000 into 6 batches, that is rupees 12,000. So there is a saving of rupees 12,000 towards inspection and setup cost. So this saving is towards inspection and setup cost. Right? Now your excess of bought out price will be rupees 72,000 plus 12,000, that is rupees 84,000. So this is one scenario. Another scenario is if Bluebird utilizes internal facility, it will generate a net contribution of rupees 80,000. How? We have done in the second part of the question. So internal manufacture will lead to rupees 80,000 cost. So what you find? you will find that it is advised for upgrading because the second cost is lesser than the first cost. So, the decision is advice is to do internal manufacture. What are the non-cost consideration, friend? Availability of skilled workforce, supply of electricity must be regular. Third, government policies and procedures of tax etc. should remain unchanged. So, this is how we have solved question number 2.